How liquid are the funds for the Deferred Sales Trust? It's our most commonly asked question because guess what? As an entrepreneur or an investor, you want the ability to time the real estate market or the investment market as best you can. And how do you do that best? By having liquidity. So let's talk about how liquid are the Deferred Sales Trust investments. Well, the answer is, depending on where we invest the funds, can be as liquid as any other investment you might make. In fact, you can go into T-bills, you can go into stocks, you can go into just a checking account, and we can maintain 100% liquidity as long as we're investing into those investments. And we can also go into passive real estate deals or even active real estate deals, and that's when it becomes illiquid because these are assets that need to be sold or refinanced in order to get the liquidity out. And so how liquid are the funds? They're as liquid as you want them to be, and what I mean by that is you approve of every single investment. Okay, so if you want liquidity, we provide liquidity. Now, of course, the returns and the risk tolerance will also determine how we map out a wealth plan. But the liquidity of the funds is just as liquid as if you just took the funds, paid the tax, and now you have them in your bank account. Now, here's the difference though, right? You are working with a promissory note that's on a set payment schedule. So your question might be, well, how liquid are the funds to me personally? Well, that's a great question. It depends on the promissory note. The promissory note may be making payments to you on a scheduled payment and then a balloon payment or certain balloon payments due within a period of time. Let's just take a $10 million exit, for example, and let's just imagine the interest rate on that promissory note was $800,000 or 8%, and the cash flow was about $800,000 per year, right? But let's say, hey, I might want to dip into the $10 million. How do I do that? Well, we can refinance or restructure the promissory note to make a large one-time payment along the way. And so how liquid are the funds? Well, it also depends on how much we've structured in the promissory note to make the payments to you. Now, how long does that take? It could take maybe a couple days to a week to change that promissory note. So the Deferred Sales Trust has really two ways of liquidity. One that's investments, and two, it's the promissory note, and that promissory note can be adjusted along the time. Now, let me tell you about one other one that's a little less liquid or a little less accessible. It's called the DST 2.0. This is reserved for deals that are 10, 20, 30, $40 million and plus. Why? Because they're subject to estate tax and we're moving the funds outside the taxable estate. But this promissory note structure is a little more rigid, meaning it's going to pay you based upon your life expectancy, and it's going to pay you a set amount, and if you're married, based upon your spouse's life expectancy as well. And it's basically a mix between capital gains tax and principal payments. Well, I guess principal is a better way to put it, and interest payments. So those two combined. And so the promissory note is not as adjustable, and so you have to be aware of that going in if you have larger deals. Now, sometimes what we do is we'll structure a promissory note, DST 1.0 promissory note and a DST 2.0 promissory note, so you have a mixture. In other words, we are customizing the plan for you based upon your liquidity needs, your entrepreneurial dreams, your passive or retirement needs, and all of this is a part of building your capital gains tax exit plan. I hope this video was very helpful, and I look forward to connecting with you soon. Go to capitalgainstaxsolutions.com to get your plan started, or if you're a client, we look forward to connecting with you again real soon. Thanks so much.